how your assets grow over time can have a big impact on what kind of wealth you accumulate, of course. Natasha Macmillan is Business Director of Everyday Banking at rethink.ca. Natasha, thanks for being with us.
Thanks for having me.
And this is very relevant for a lot of people who are saving and investing for the future, because the less risky part of that equation hasn't been very good for a long time. Low rates mean bonds don't do as well as they do when inflation and rates are high. And even your savings, of course, do nothing. What's your advice to people in a low rate environment who are still worried about taking on the pure risk of the stock market?
So a high interest savings account is always the best place to consider, depending on your risk appetite and what we're seeing in the market today. It allows you to kind of earn more interest today, anywhere between 1 to 3.5%, in an environment that makes you feel comfortable and safe to ensure that you're kind of growing your base savings.
And of course, this low rate environment that, even though we've seen rates coming up here, they came up, of course, as we fought inflation, they're coming back down. Do you have a view of how low we get on rates as we kind of settle back into whatever the next normal level is?
Typically, what we expect and what we've seen in the past is high interest savings rates accounts and savings account rates move in lockstep with the Bank of Canada rate announcement. So as those rates continue to go down, if they do, we do anticipate savings rates dropping by roughly the same amount as well. It is a great thing to continue to do your research and ensure that you're looking for the best rates out there, because some banks do offer a better rate than others. And so ensuring that you're finding that best rate and maximizing your savings is critical.
Do you feel as though Canadians shop around as much as they should for these kinds of things, even bank to bank, or do we get kind of sticky with our existing bank?
I'd love to say that we are those that shop around, but even speaking for myself, we tend to stick to what we know, typically the bricks and mortars and the banks that we have worked with for a longer period of time. I think we are starting to see that shift in our population, that we are more focused on what is the best product for us for our goal. And that is something that has evolved over time, but we are still behind what we would anticipate where we should be.
And of course, inflation is one of the most pernicious things that can happen to people in terms of eroding savings and their overall wealth. Is it your expectation that inflation is behind us? Obviously, we have this massive issue of tariffs that's creating a lot of uncertainty for people. We don't quite know which direction that all goes, but how big a factor is inflation for people who are trying to save?
I think inflation is always a worry for individuals who are looking to save. And in times like where we are uncertain about what's happening in the market, uncertain about kind of entering into a recession, it's even more important to look at setting yourself up for financial success. So that can mean paying off any debt that you may have, and even looking to add the extra few dollars to a savings fund, an emergency fund, or anything like that will actually get you ahead in the long term and ensure that you're set up for success.
Do you have thoughts on advice about the size of those funds, what people should have in their emergency funds, what they should have in savings, as people are trying to figure out how much to set aside from their operating costs?
Typically, they say anywhere between 3 to 6 months is what is recommended. Of course, if you can get well above that on your run rate, that's even better and kind of helps you out in the long run. That does tend to be, depending on the burn rate of any family, can get to be extensive. So it is always important to put as much as possible into those funds for that rainy day should it come.
Natasha, so good to have you for this. Appreciate your time.
Thank you so much.
Natasha Macmillan is Business Director of Everyday Banking at rethink.ca. Part of the problem with planning well for retirement is having a real grasp of what you need. Fortunately, there are some tricks to figuring that out. Fred Vettese is an author and retirement expert, former chief actuary of Morneau Chappell. Fred, great to have you with us.
Hi there.
So I want to start with whether you think most people are prepared. When I look at the data on kind of the average that we have at retirement, it feels like not enough. Where do you think most people stand?
No, that's kind of interesting. Morneau Chappell, when I was there about 15 years ago, we actually did a survey of our clients, and we got responses from over 100 of them. 70% of them thought there was a retirement crisis. Then Bill Morneau and I produced a book about this, showing that there was no crisis. And 2 years later, we did the same survey again, and 70% still thought there was a crisis. So we didn't change anyone's mind. So people have thought of this for many, many years, that there is a retirement crisis in Canada, but it never seems to materialize. But I would say for the average viewer, the more important question is whether they themselves think that they're prepared. And you know what? As long as you're saving 10% a year, I don't really think people are going to have a problem.
And of course, that number would change depending on when you start. If we were all lucky enough to start at 18, it's a much lower number in terms of what you got to put
You don't
away.
have to start at 18. I think if you start at 30,
Okay.
and you save consistently at 10% until your 60s, you're going to be fine.
And so I do want to ask you about people that start late, because there are some people who, for whatever reason, especially now, maybe because they're saving for big assets like a home, they haven't really started until they're into their 40s. Does that change the formula on what we need to put away?
It changes the formula for sure, but it still is quite doable. In fact, I kind of covered this in my book called The Rule of 30. And what I showed was, in fact, I said most people in their 30s, they really can't save that much because they have a mortgage, they got daycare to worry about, they have other expenses that happens in early life. Early family life, so they just can't save that much, and so they shouldn't sweat it. They ought to be thinking about maybe saving 5% in their 30s, 15% in their 40s, and then maybe more like 20 or 25% in their 50s. And while that sounds like it may not be doable, the fact is by the time you're in your late 50s, the mortgage is probably paid off on the house, and maybe the kids have finally left the home as well. And so you actually have a lot more disposable income anyway.
That's one thing I wanted to ask you about, is whether these calculations change if people don't own their home. We're seeing longer amortizations. We're seeing bigger first, home price in the first place. Will it be a different calculation for people who are a little bit younger, who may not own their home by the time they retire?
I would say the answer is yeah. They would probably be a little bit different. They ought to be saving a bit more in that case, because the way I look at it is that saving is saving. It doesn't matter whether or not you're putting the money toward a mortgage or you're putting the money into your retirement account. Both ways you're saving for your older age, really. So if you're not saving toward a home and you're only paying rent, then probably yes, you probably do have to save a couple of percent more of your pay every year.
When we look at the supports for older people, there's CPP, if you've paid into it. There's OAS, which is often talked about as something that should be increased by various politicians over time. Are there plenty of supports for people who may have less privately saved or in a pension, but that would rely on the government?
Well, I guess the good news is that both those programs have been improved over the past 10 years. Bill Morneau, when he was finance minister, got the other finance ministers together to expand the Canada Pension Plan. And while it will take a while to totally phase in, as a result of it, it means that rather than getting 25% of salary from the Canada Pension Plan, the ultimate percentage will be more like 33%. So that's one improvement. The other improvement was the government a few years ago expanded the old age security program so that people, once they reach age 75, get another 10% boost in their OAS payments. So overall, the government's actually provided, I would say, quite sufficient help for people in their who are saving for retirement.
And based on your research of our own savings, what's the rule about what we should expect to withdraw every year? When we look at our pile of cash, is there a percentage we know we can count on to take out every year so that we know it'll last us?
I covered that actually very, very recently in the Globe and Mail article, and I talked about the rule of 40, which the rule of the 4% rule, which I've always found a little bit suspect. This was first devised back in the 1990s. 4% rule says, let's say your savings were, just to make the math really simple, $1 million. 4% rule says in the first year you can withdraw $40,000. Second year you withdraw the 40,000 plus inflation, and so on until the rest of your life. So I actually tested that rule, and I found that the 4% rule, if anything, has been conservative since about 1950. I didn't test before 1950, by the way, but it has been conservative, and so the 4% rule has always been sustainable. In fact, it could have been as much as a 7.5% rule under in certain eras in the past. But I would say rather than rely on a rule, if you've got multiple hundreds of thousands of dollars in savings, you ought to be using more science as opposed to simply rule of thumb that you can remember in the back of your head. And we have excellent retirement calculators out there, and those ought to be used. And obviously, financial advisors are using calculators as well. And you ought to use those to figure out how much money you can withdraw.
Very good advice, Fred. So good to have you with us. Appreciate your time.
My pleasure. Thank you.
Fred Vettese is an author and retirement expert, former chief actuary of Morneau Chappelle. Coming up, a lot of investors want to do good but still make money. We'll talk about the options after this.